month.
A very good afternoon, good morning. Welcome to our live trading webinar. We are just having the inflation data break as we start the webinar. So I'm just going to quickly run through the introduction and then explain the implications of that CPI print that we have. So we haven't had the outcome I was looking for. So we haven't got an obvious tradable opportunity, but I'm going to explain what maybe there is in place as we just run through what's going on. Just bear with me as I just turn the squawk off. Great. Welcome to the workshop. You are joining us right in the thick of things as we try to digest exactly what's going on through the latest US CPI print. That is the big focus of the markets. It's the big focus of our workshop. And we're going to be looking at that now. Don't forget, as we look at different entries, exits, even different currency pairs and instruments, this isn't a trading advice on this workshop. The idea is you look over my shoulder, someone from a professional trading background, you go and see about how they make trading decisions, and that's a way of increasing your education. So we're looking at how to trade the US inflation data. And remember, one of the key principles that we teach over and over again is how do you choose which currency pair to trade? Well, just like this diagram, you want to choose a strong arm. You'd expect that this strong arm would beat the weak arm every time, don't you? So we're looking to back a strong currency against a weak currency. That's the key aspect we're looking for in our trading. Now, the CPI print we were looking at today has just come in. So I'm just going to go through what that looks like, and we're going to unpack what that means for markets. Don't forget, you can ask questions at any point during the webinar, and I get to see them on my screen, and I'm very happy to either answer them as I go along if it's appropriate, or wait until the end. Now, if you just take a look at the inflation print, you can see that the headline has come in at 8.3%. which is above the forecast, but it's not above the maximum forecast. So the forecast was 8.1%, it's coming at 8.3%. The core reading has come in at 6.2%, and the forecast was 6%. Now, let me just explain to you what's going on. If you just take a look here at the following print, you see here, this is the previous inflation and core inflation readings. And what we've been seeing is that the headline inflation print was moving higher, but the core inflation was moving lower. So many people were speculating, are we past peak inflation? And many investors want the US to be past peak inflation, because remember, the Federal Reserve are hiking interest rates in order to keep inflation down. So if inflation starts going down, then that takes the pressure off the Fed hiking interest rates. That will weaken the US dollar, and that will send US 10-year yields moving lower. So going into this meeting, let me point something out to you. Do you see how the forecast expectations at 8.3% was below the previous reading of 8.5 for the headline, and the core reading 6.2% was below the previous reading of 6.5%. In other words, economists who were surveyed were expecting to see inflation drop, and broadly speaking, they have fallen within the low and the high, the minimum and the maximum expectations. So the way these forecasts work is a number of economists are asked, what do you think the inflation print will be? The lowest one was 7.9%, the highest one was 8.5%, and then the average forecast was 8.1. Okay, so that's what the expectation is at. So with the print being 8.3%, it's slightly higher than forecast. The core is slightly higher than forecast. So going into the event, people have been talking about something called a base effect. Now, the base effect in economics is simply the difference your reference point makes. Now, the base comparison for today's print is going back 12 months, back to April 2021. And you can see that when the base comparison goes from April 2021, it's moved from March 2021. So now the comparisons on a year-on-year basis are all comparatively higher. So in other words, the base effect is that the inflation print will have to be, really high to keep moving up. The pressure on the inflation headline print should be moving lower now because the point of comparison is so much higher, over 4%. So that's why when you look at the forecast, you can see that the forecast is being expectation is lower than the previous reading. Now, the trade I was really looking forward to and, really getting ready for, which is why I put the screen just up here before we started the webinar. I just kept it going and kept the squawk on so you could see the data point actually as it came in from a professional news feed, was because if we saw a disappointing inflation print, say the inflation print had come in at below 5.8 for the core and below 7.9 for the headline, if that had happened, the dollar would have weakened. And then I was really interested in buying the euro US dollar pair, because we've had a lot of hawkish speakers coming out talking about the ECB having to hike interest rates in July. And if you just take a look at this is very interesting. Wrong way. If you just take a look at this, you'll see that short-term interest rate markets are now pricing in a 72% chance of the ECB hiking interest rates by 10 basis points in June, right? So expectations are really increasing now for an ECB interest rate hike. And you can see, if you just look here today since open, now all of a sudden, look, you see the US dollar has given back quite a lot of those gains on that print. Now, the situation for the dollar has been very interesting. If you remember the FOMC decision from last week, the Fed hiked by 50 basis points. They projected two more 50 basis points hikes to come. But short-term interest rate markets, if you just take a look here, they are now pricing in a 73% chance of a 75 basis points rate hike when at the next Federal Reserve meeting on the 15th of June. So this tells you something very interesting. It tells you that the short-term interest rate markets don't quite believe the Fed's rhetoric. They think the Fed's going to be under more pressure to hike interest rates more quickly as inflation is moving up more quickly than the Federal Reserve are perhaps expecting. And today's print kind of gives weight to that view, doesn't it? Because look, inflation is once again coming in above forecast, but below maximum expectation. So there isn't an obvious trade here, okay? There isn't an obvious trade. Now, what I want to quickly look now is inflation expectations. Now this is going to be a very interesting little thing to look at. I'm going to look at a couple of markets that we use for looking at inflation expectations, and I'll just show you them here. Yeah, here they are. So we're looking at 5-year break-even inflation rates in the dark blue and 10-year break-even inflation rates in the light blue. Now, if you notice something, when inflation is rising, okay, that tends to push commodities like oil higher. Do you see how oil is tracking inflation expectations? So as inflation expectations soar, that boosts oil in the purple line, and it also boosts commodities. So you can see how, do you see how closely they will track each other? So what you want to see to get like a breakout or get like, a move lower is you want to see break-even inflation expectations moving lower. Now, at the moment, we've got 5 years pretty low and 10 years moving lower. Now, we need to see how they respond after this latest inflation print. But if they start tracking higher again, that's going to push oil higher, it's going to push commodities higher. So inflation is absolutely major focus, and it's a key focus for the US dollar. And that's where we're going to get that, best potential response, is on how things work regarding the US dollar. Now, going into this meeting, you see, I'll teach you some learning points here, okay? And one of the learning points is what we saw on the daily chart. Do you see how you had a candle, mother bar candle, mother bar candle? You see this coiling price action? That's typical of explosive price action. So what you typically expect is an explosive move out of this. Now, we might get a false rejection. If we get a false rejection from that level, that will be an important reversal signal as well. Now, look at this very carefully and how price moves. The opportunity that I can see here, you can see that that short-term trend line's been broken lower, is if you find buyers coming in and pushing it back up into that range, and then we get a break above those highs, that's a very bullish development. Now, that's only technicals because there isn't an obvious trade here, but just take a look at this, the bond yield spread between German 10-year bonds and the US 10-year bonds. Now, what you can see, now, the reason you look at a bond yield spread is, do you see how closely the price tracks the bond yield spread? You see, as the bond yield spread moves lower, price moves lower. Bond yield spread moves higher, price moves higher. Bond yield spread moves lower, price moves lower. Bond yield spread moves, you see? So the bond yield spread really does dictate where price goes. Now, if the bond yield spread keeps moving higher, in other words, if markets think that the ECB are going to be hiking interest rates before the US, that will push the German US 10-year yield spread higher. That will pull euro US dollar higher. So look at this. This is a massive level because we're right at this key support level, going right back to 2017. So we're in a major support level. There isn't anything obvious to trade, but just look out for any false rejection of this level and a potential push higher. If that breaks and closes lower, and that bond yield spread sort of stays depressed or stays where it is or flatlines, then you expect further downside. But if we get the bond yield spread moving higher, then that would be really positive for the euro US dollar pair. Now let me just explain to you how that bond yield spread works. So I'm conscious that might be new for some of you, but it's probably one of the most important indicators that you can look at to help you in your trading. Now, what the bond yield spread is showing you see here, this is German bonds, this is a US 10-year bond, and the bond yield spread is literally the difference in the spread between German bond and the US bonds. I think why are you using German bonds when you're trading the euro is because there isn't a European bond. So you use the German bond, which is known as the Bund, and that gives you a proxy for the Eurozone. And when the bond yield spread is moving, when the yield is moving higher of a bond, it tells you that investors are expecting incoming interest rate hikes. So the yield spread between the two basically tells you which country the market is expecting to hike interest rates more quickly. It's a way of just kind of unpacking some of the difficulties that there are and giving a nice clear indication of what the expectations are for the interest rate moves over the short term. So you can see if this sort of keeps pushing higher, the euro US dollar, the Bund, German Bund US 10-year Bund, which is the yellow line, if that keeps pushing higher, that will support euro US dollar higher. We can look for a retest potentially up towards that 107.20 and then potentially up to 108.80, just on a kind of mean reversion. Now, why do I think there might be some mean reversion? Well, it's just simply for this reason. This is the dollar index, right? Now, if the CPI had been a miss, the dollar index would have, moved lower. Now, the dollar index is moving higher now. Why? Because inflation expectations are ramped up. We've just seen the CPI print, headlines 8.3, cores whatever it was, 6. Let's just remind ourselves, I think it was Cores coming in at 6.2, headline 8.3. So inflation expectations are right high, they're up there. That's where the dollar's increased because it justifies that view that the Fed's going to have to be more aggressive in hiking rates. That's dollar positive. So medium term, it's bullish US dollar. We are bullish the US dollar medium term as well. You can see since the start of the year, look how the dollar's been gaining, right? But eventually the dollar's going to get near peak bullishness. So where is that point? Well, the difficulty we have here is another difficulty. The dollar, let me show you something that will help you. The dollar can be tricky, right, when you're to trade, particularly when you're learning to trade, because it's a really, this is called the dollar smile theory, and it was, I think it was a JP Morgan trader that coined this, 15 years ago. But it's really helpful. Okay, when you see the US dollar outperform on two ways. One, when you've got US outperforming the rest of the world, you see the dollar appreciate. When the US is doing better than other countries. Now you also see the dollar appreciate, weirdly, when the US is in a recession or when there's a synchronized global slowdown. So that means that the dollar is appreciating at the moment for two different reasons. One, the Fed having to hike interest rates more quickly to contain inflation. That's been surging 10-year yields, that's surging the dollar higher. And two, what have we started to see in markets? A little bit of a global growth slowdown. So that also supports the dollar higher. So look at this level really carefully, that 104. If we get a break and close above that 104 level, that does potentially open the way for more gains and another leg higher in the dollar. So look at this very, very carefully. We've got that big overhead resistance level. And if that 104 level breaks, the next test is coming up around that 105, 106 region. So it's a very big reason. But you see how stretched the market is here. You see how much that, and markets don't move in straight lines. You see, they move in these sort of waves, these corrections. So eventually, we're expecting the market to correct because this bullishness of the dollar has been priced in since January. But a print like today, all it does, it helps the dollar gain. And remember, if we see this, the US, if we see a synchronized global slowdown, so if COVID cases gain in China, China starts shutting down factories, if there's not the recovery in the world, then the US dollar can also appreciate for that reasons. The dollar tends to appreciate when there's synchronized global growth. Because if you think about it, dollars can flow out of the US into the rest of the world as investments of US dollars and move. And also the dollar is the world's reserve currency. So when global growth is going really well, there's not the need to have your reserves in dollars. So you can allow some of those dollars just to leave those reserves, buy other currencies, make other investments. And so you tend to see the dollar depreciate as it's sold and moved around the world. I was in Athens just a few weeks ago, and one thing that really struck me was how many US citizens were in Athens. So if you think about it, that's, when the US is doing well, of course, you're going to have US dollars going around the world, aren't you? So the US dollars are going to be converted into euros. So you can see that the dollar will obviously depreciate in that situation. And it struck me how much influence the US had on Greece's economy. It would be huge. There were loads of US folks there, and obviously selling their dollars to buy euros, and all of that is a force for US dollar depreciation. So in other words, when that synchronized global growth going on, then you're going to see dollar depreciation. Okay, folks, that is the main thing I wanted to share with you today. But I do have something else for next week that I want us to start looking at, and I'll tell you why. Because we've got some wage price data coming out for Australia next Wednesday. It's going to be the subject of the workshop this time next week, but it comes out before the event, the night before. So I want to show you how to trade it in advance. So we're going to go over, and I'll just show you what I'm looking for, or rather is the correct terminology. Now, if you just take a look at 18th of May, you can see that we've got this Australian wage price index. Now you might think, well, what's important about that, Charles? Well, it's very important. And you can see on my blog, if you go along to my blog, you'll see under market fundamentals, if you look at central bank watch, I often update central bank outlooks. Now, we look at the RBA decision and I unpack that. And if you notice what I said, the RBA they hiked by 25 basis points, surprise markets, they sent the Aussie soaring, okay? And we were looking at a weaker pound Australian dollar into that meeting, and you'll notice that the pound Australian dollar sold off heavily from these levels. We were looking at selling from this broken trend line, and if you notice, price moved back down to that 1.572 region, okay? So that's what I was looking at the time. Now, when that decision took place, it was a very hawkish one for the Australian dollar, because the RBA had been saying that they said they wanted to see that inflation was in the wage data before moving on hiking interest rates. But they went ahead because inflation has picked up more quickly and to a higher level than was expected, and there is evidence that labour costs are increasing more quickly. So in other words, what they were saying is they've hiked interest rates early because inflation is much higher than they had anticipated. That's what boosted the Australian dollar out of that decision. Now, recently we've had dollar strength that's mitigated some of that Australian dollar, but there is a hawkish shift taken place by Australia. The reason I'm not bullish Aussie dollar at the moment is because of the slowing growth in China. And if you notice, the commodities are dropping in Australia as well. So if you just take a look at here, iron ore prices, so see how they're dropping lower? The iron ore is the white line, and that pressures the Australian dollar as well. So you've got stocks moving lower, S&P 500 moving lower. But let me just put some of these out on the chart for you. You'll see them, right? It'll be obvious to you. Let me just. Right, let's have a look here. Right, let me show you this here. Right now, right, that is iron ore prices dropping. The Aussie basket's dropping. Look at the S&P 500. S&P 500 dropping, dragging Australian dollar down. And look at China's 50 index dropping, dragging the Aussie dollar down. So commodities, stocks, the China 50 index all pushing lower is all a pressure on the Australian dollar. So there's pressure on the Australian dollar to the downside, even though the RBA has turned more hawkish, right? So their justification for an earlier interest rate hike was high inflation in the wage price data. Now, they had been holding out for this wage price index print, okay? What they wanted to see is, you know, it's 2.3% is the expected. Now, if that comes in like a big surprise to the downside, you can expect Australian dollar weakness. So say you saw this come down, like, you know, comes in at 2.1%, then expect immediate Australian dollar selling, and, you know, and that would be pairing it against a strong currency at the time. So watch out for that. It's major focus. Now, if this comes in high, that's just what markets are expecting. Okay, now if it comes in very high, you know, maybe it probably have to be like 3 plus. Then that should see a short-term pop higher in the Australian dollar. But remember, they've already hiked interest rates because they can see inflation in the labour data. So that won't be anything new. The best opportunity will come from a miss to the downside. So reduction in the wage price index will be the best tradable opportunity. Folks, I will talk about this again on Monday. So don't forget to come along on Monday and follow me there. In the meantime, you can catch up with me in a number of ways. So first of all, don't forget my blog. That's a good way to keep in touch with me, as I've already shared with you. And don't forget to follow me on my Twitter feed as well, and on LinkedIn. I put a lot of material up there, and you can follow me at Giles Coughlin CCA. You can just see that you can just use this here. I'll just put that in the chat box. And that is my Twitter handle, so you can follow me there on Twitter. Folks, I hope that's clear. It's been a pleasure, as always. I hope you feel you've got a really better understanding of what's going on with the dollar. It's really crucial to understand the dollar. It's a dollar-centric FX world, and the dollar is the most widely traded currency in all of the world by a long shot. So understanding what's going on with the dollar will help you understand what's going on in markets more generally. Okay, folks, been a pleasure. Take care, and I hope you have a very good rest of the session. Thanks everyone now. Thank you. Goodbye.